Today, let's discuss the most basic of concerns everyone has, but few ask about. I have a small amount of savings. Should I invest all of it into stocks? What about if I have emergency needs? We'll address all of that, plus our thoughts on 401ks, IRAs, Roth IRAs, and T-bills. We'll give you our independent step-by-step thinking to save you time and maximize your money for 2024. If this sounds good to you, then please like and subscribe. Without your support, we cannot make more videos. Also, check out our best stock trading guide links below to help you make even more money. So, let's get right to it. Step number 1. Emergency savings. At our channel, Stocks, Finance and Trading, we love talking about stocks. But here's an important rule to understand. Investments must always take a backseat to life directions or emergencies. An example of a life direction is, you're getting married, you need to buy a new car, or you need to pay tuition. In these situations, and if you can't get favorable financing, then you need access to your cash. Similarly, the possibility of an emergency is the same thing, except you won't know when or whether it may happen. But their possibility of happening is so life-changing, that you need to set aside some savings for it. If all you had was $10,000, how should you manage it? In today's video, we'll use this example amount for simplicity. How much of it should you keep for emergencies? How much of it should you invest? Typically, you want to keep 2 to 4 months of savings on hand for emergencies. Examples of which are moving, job loss, and medical emergency. First, let's determine your burn rate. Your burn rate is all your usual costs in 1 month. This includes housing, utilities, car, food, everything. Let's say your burn rate is $1,500. You work an average office job, and if you lose it, you don't feel it would be difficult to find another. You feel if you had to find another job, then it probably wouldn't take longer than 2 months. So if you lost your job, then you would need at most 2 months to live on while you looked for another. 2 months of your burn rate is $3,000. So you would want to put $3,000 aside into a savings account. For most people, 2 months is fine, because you can always access your investments soon after if needed. But the wait time may be 6 days. That's an average of 4 days for brokerages to settle your stock sales into withdrawable cash, plus the transfer itself takes 2 days. If your possible emergency may be more expensive, then you can set aside up to 4 months, or even more. But obviously, if your possible emergency is something very expensive and complicated, then it may not be proper to think about investments at all. But even in the most extreme of life situations, we always recommend investing just a minimal amount into stocks. Even if all you can afford is to invest $5 a month, then we strongly recommend you do it. Many brokerage accounts have no minimum balance requirement, and some offer fractional share purchasing. We'll talk more about this later. Back to your $3,000 example savings. Google search, highest yield savings account. Look for results hosted by NerdWallet, Bankrate, The Motley Fool, or Investopedia. Choose a few banks to investigate, learn more details on their terms, and open your account online. Savings accounts by law restrict withdrawals to 6 per month. But if you're like most people, then you want the freedom to make more withdrawals. This is especially necessary if your savings is much more than $3,000. So you may want to split your $3,000 into 2 or more different bank savings accounts for higher flexibility. As of the time of this video, online savings accounts pay more than 4%. This interest is taxable by both federal and state. Step number 2. Investment capital. $10,000 less $3,000 for emergencies is $7,000 for investments. Later, in step number 3, we'll talk about different retirement account types. But for now, let's continue with investment capital. If you're young, then we recommend 10 to 20%, or $700 to $1,400 of your investment capital be invested into a low-cost S&P 500 exchange-traded fund, ETF. If you're middle-aged, then you can increase this percentage to 30 to 40%. If you are older, then increase it to 50 to 60%. Bond ETFs, although promising to provide stable income in your retirement years, can be proven to losing a lot of money. In 2023 and 2024, many bond funds actually lost a lot of value for shareholders because of Fed interest rate movements. So here's how we, at this channel, differ from most traditional financial advisors. We do not recommend any investment levels into bond funds, even if you're older. The S&P 500's high performance track record more than makes up for a bond fund's limited growth to risk profile. We use Vanguard S&P 500 ETF, ticker symbol VOO. Vanguard is a long-established investment fund company offering many mutual funds and ETFs. It's most famous for the lowest cost structures in the entire industry. VOO's annual expense ratio is 0.14%. That's a little more than 1/10% annually. You can buy VOO's shares just like a stock through most any kind of brokerage firm you use. Why put your money into VOO? Doing so will easily and conveniently give you diversification on a good portion of your investment. VOO's holdings include many important growth stocks you've heard of. They include Apple, Microsoft, Amazon, Nvidia, Alphabet, parent of Google, Meta, parent of Facebook, and Tesla. So you can see, putting 10 to 20% of your investment capital spread out across these important names gives you safety by diversification, but also growth. Let's say you are young and want to put 10%, or $700 of your investment capital into VOO. But the current price of one share of VOO stock is nearly $500. Look into trading apps or accounts that allow you to buy fractional shares, like Robinhood. A smart way to build your position into VOO's shares is over time and buying on dips. Divide your $700 into maybe 10 portions. On Sunday soon, buy $70 worth of fractional shares of VOO. Then wait several days. On another dip, buy another $70 worth, and so on until your full $700 gets invested. Fractional share buying allows you to buy shares of any high-priced stock with smaller dollars. This is a great opportunity for smaller investors. If you don't have a Robinhood account yet, then use our referral link below to receive your free mystery gift stock. In part 2 of our video, we'll continue with investment capital, cover retirement accounts, and treasury bills. See you there. That's it. That's part 1 of how to manage and invest $10,000 if that's all you had in savings. Don't forget to check out our best stock trading guide links below to help you make even more money. It's important to note that past performance should not be used to predict future gains, and diversification is essential in any investment strategy. Please consult with professionals for any tax strategy, and before investing in any securities. If you liked today's informative video, please like, subscribe, and comment. It motivates us to make more videos like this. What other kinds of topics and stocks would you like us to cover in our next video? Comment your ideas below. Turn on your notifications to be alerted when our videos get published, because many of our videos may contain market timing advice to help you make money. Happy investing, and we'll see you in our next video.